Welcome to Rich Tribe. Have you ever made a quick, unexpected profit in the market, felt absolutely invincible, and then blown it all on a completely reckless risk the very next day? You probably justified it, right? You told yourself you were just playing with house money. Well, what if I told you that exact thought process is a devastating psychological trap? It is literally the invisible barrier keeping everyday folks from building real generational wealth. Today, we are tearing down the behavioral biases that are quietly draining your portfolio so you can start investing like the top 1%.
Okay, John, but let's be real for a second here. If I invest 10 grand and suddenly I'm up 50%, shouldn't I be a little more aggressive with those profits? I mean, it just feels so much safer. If I lose it, I'm just losing my winnings, not my hard-earned principal. It's just house money, right?
I completely understand why it feels safer, Monique. Honestly, I do. But that right there is exactly how the average person thinks, and it's exactly why they stay average when it comes to wealth. The house money effect is a heavily documented cognitive bias where our brains mistakenly separate our initial investment from our actual winnings. Think about a totally novice gambler walking into a casino, they bring $200, they happen to win $5,000 really quickly, and suddenly they start making wild, irrational bets. Why? Because they don't view that 5 grand as their money. They view it as the casino's money. But listen to me, once it hits your portfolio, it is 100% yours. Treating it as found money is just a guaranteed way to give it right back to the market.
Well, I get the casino analogy, but a casino is literally built from the ground up for reckless gambling. Does this actually translate to everyday investors in the stock market? Like, is there real, hard data showing people actually manage their life savings this way?
Oh, the data is absolutely crystal clear. Look at this massive 2005 study by Massimo Mazna and Andrei Simonov. They tracked Swedish investors across both the stock market and the real estate market. The findings were honestly staggering. Whenever these everyday investors booked significant capital gains, they didn't secure their wealth. They didn't diversify. Instead, in the very next year, they consistently moved their money into much riskier stocks. They won, they felt invincible, and they immediately doubled down on higher risks. It's a literal, real-world execution of the house money effect.
All right, so winning makes us dangerously reckless. That makes sense. But what about the flip side? When the market crashes and I lose my actual hard-earned money, do we just become completely paralyzed? Precisely. You hit the nail on the head. If the house money effect is the euphoria of winning, the dark flip side is the snakebite effect. When people suffer a sudden financial loss, they feel like they've literally been bitten by a snake. Even if the broader market fundamentals haven't changed one bit, they become utterly terrified of the tall grass. They refuse to take on even reasonable, calculated risks, and as a result, they miss out on the exact opportunities that could build their wealth right back up. Let's look at a historic, undeniable example of the snakebite effect in action. During the 2008 global financial crisis, the Nifty 50 index experienced a brutal 60% drop, hitting rock bottom at 2,959 in December of that year. So many new investors were absolutely traumatized by the freefall. They sold everything out of sheer panic and vowed they would never, ever return to the market. They were severely snake-bitten. But here is the heartbreaking tragedy of it all. By January 2020, the Nifty 50 had rebounded to 12,389. Those terrified investors permanently locked in their losses at the exact bottom and completely missed a historic decade-long bull run. Wait a second, I actually know people who lose money in the market and they don't run away terrified at all. Instead, they get super aggressive. They furiously start day trading, trying to win back their losses immediately. Isn't that sheer desperation to break even just as dangerous? You've zeroed in on the one major exception to the snakebite effect, and frankly, it is arguably the most destructive trap of them all. When the pain of a loss is really acute, some investors just throw all logic completely out the window. A 1998 study by Joshua Koval and Tyler Shumway actually analyzed full-time proprietary traders at the Chicago Board of Trade. These are professionals. And they found that when these pros lost money in the morning, they took terrible, uncalculated, ultra-high-risk bets in the afternoon just to frantically recoup their losses. And on average, those afternoon revenge trades ended in absolute disaster. This is fascinating, but it's also kinda terrifying. We get completely reckless when we win, totally paralyzed when we lose, or blindly desperate when we're down. Why is human psychology so fundamentally broken when it comes to managing wealth? Like, what is the actual glitch in our brains here? The root glitch is a behavioral concept called mental accounting. See, instead of looking at our total wealth as one big fungible pie, we irrationally divide our money into separate mental buckets. We group our investments based solely on whether they are currently winning or losing. And we do this subconsciously to manipulate our own emotions. We desperately want to maximize our psychological comfort and minimize our emotional pain, completely at the expense of our actual net worth. Let me show you just how wild this mental gymnastics gets. In 2006, researcher Sonia Singyan Lim examined 50,000 broker accounts. She found that investors systematically try to bundle their pain. If they have several losing stocks, they will literally sell them all on the exact same day, just to get the emotional agony over with in one single painful blow. But if they have winning stocks, they sell those off slowly, one by one over time, just to savor the joy of winning. They are literally structuring their trades around dopamine hits, not sound financial strategy. Okay, so if the average person is making massive life savings decisions based on cheap dopamine and fear, how does someone actually break out of this matrix? I want the blueprint here. How does a millionaire investor actually bypass this stuff to build serious, lasting wealth? The millionaire blueprint starts with deeply understanding this one profound truth from Warren Buffett. He said, the stock market is designed to transfer money from the active to the patient. That hyperactive trading caused by the house money effect, the snake bite effect, and that desperate need to break even, that is exactly what transfers the average guy's money directly into the pockets of the wealthy. True wealth requires stripping the emotion completely out of the equation. Now, before I give you the exact millionaire strategy to bulletproof your portfolio against your own psychology, I need you to do 4 quick things. Step 1, subscribe to the Rich Tribe channel so you never miss these wealth-building insights. Step 2, like this explainer. Step 3, comment your thoughts below. Honestly, have you ever fallen for the house money trap? And step 4, share this with a friend who really needs to hear it. All right, here is how the wealthy actually do it. First, you must completely ditch the casino mindset. Every single dollar in your portfolio is yours. There is no such thing as house money. Second, you use dollar cost averaging, or DCA. You invest a set amount of money at a regular, boring pace, regardless of whether the market is up or down. Third, you automate those investments. Automation removes the emotional conflict we all have. You don't have to wake up and decide to be brave or fearful. The system just executes the plan. And finally, you step back and let the sheer math of compounding returns do the heavy lifting over decades, completely immune to the daily noise. So, as you look at your own portfolio today, I really want you to be brutally honest with yourself. Ask yourself this one critical question. Are you treating your life savings like a casino chip to be gambled on a whim, or are you treating it like the unshakable foundation of your future empire? The choice is entirely yours. Thanks for joining us on Rich Tribe.